And I appreciate everyone being here today. My name is Jill Verscher with the MBA Service Corporation, and I have with me today Joel Pruce and Jennifer Wagner from Cornerstone Advisors. So thank you for joining us. You are with us for the webinar on Banks Need More Than Prayer as Borrowers Seek PPP Forgiveness. Just brief introductions of our two esteemed Cornerstone advisors. Jennifer Wagner is our Client Relations Director. She works directly with our Michigan banks. Jennifer grew up in Sterling Heights, Michigan, and she's a graduate of WMU. She shared with me actually that she was really sad this year missing her annual summer trip to Lake Michigan. So she loves coming back. Her aunt actually is a longstanding customer with one of our community banks as well. So Jen is our first touch point for Michigan banks to work with Cornerstone Advisors as they discuss performance improvements, contract negotiations, and strategic planning. And Joel Pruce is he is in the commercial and small business segment. Joel brings more than 25 years experience delivering the fundamental change in the origination and ongoing management of credit relationships. In his role at Cornerstone, Joel is focused on commercial credit performance improvement, covering policy, process, roles, and responsibilities for both loan origination and ongoing customer management. Prior to joining Cornerstone Advisors, Joel was the senior business consultant in Experian's global consulting practice, delivering policy review, decisions, strategies, and process redesign, generating significant return on investment for his clients in the commercial and small business credit segments. In addition to his consulting experience, Joel has more than 15 years of practical commercial credit experience in the financial industry. So with that, we welcome Joel and Jennifer. Please feel free if you have a question as we're going throughout the webinar. We would love to hear your questions as they arise. So feel free to put them in on the chat and we will keep an eye on those coming in. So thank you very much. And Joel, welcome.
All right, thank you. Welcome, and appreciate the opportunity to talk with you today on kind of a current topic around the PPP loan forgiveness plan. Just a brief aside, born and raised in Michigan, so in Grand Rapids, and went to Calvin College, so a little bit north of the Western Michigan folks there, and got my start in banking at Michigan National Bank. So I don't know if anybody remembers that bank from way back, but started as a commercial credit analyst there. So glad to be in front of you today as we go through the topic on the PPP loan forgiveness. So we're not going to rehash, everything about kind of everything that we went through, and I shouldn't say we, I should say you went through as you were going through the application process. But really wanted to talk about some of the results and that we saw from the program itself. And so just to recap, we dispersed $525 billion. The bulk of that was done during the first round with the dollars. The bulk of the loans, the number of loans, were done in round two, as you can see here. And noted that there's around June 5th, when they switched the guidelines or the kind of the product parameters in the loan, they switched it from a 2-year maturity to a 5-year maturity. We'll talk about that in a little bit later, but huge effort on behalf of everyone. And in fact, as we were talking with our clients, just hearing what everybody went through and trying to just stand up a process, get these applications through the system, and get the money into the hands of their small business borrowers. So wanted to take just a real quick check and go through a poll question here just to find out, and Jill, maybe you can post that poll. how did you guys process your PPP loans? So did you have an industry vendor platform that was provided to you that you purchased and stood up? Did you refer to a third party and they processed the applications on your behalf? Or did you do something internally? Or was it, all manual? Just kind of rolled up your sleeves and sludged through it and got them all done. So if you wouldn't mind just taking a second and recording that, your responses there, and then we'll wait for Jill to get the responses out. It's pretty interesting to see kind of as we talked with our clients, what they were going through. And I know the long hours that everybody put in, particularly even if they had an automated process that was in place. So.
Just a couple more to respond yet.
Okay. And again, more kind of a curiosity on our part as we see what the distribution was. So 83% manual. Well, regardless of how you process it, those applications, I know that it came upon us very quickly. We had to respond quickly to make sure that we, got the application submitted before any money ran out in each of those cases. So I really want to just put out there, thank you. You all did a fantastic service to the country, to the economy, to your customers themselves. And I don't think we can say it enough that thank you for what you did to get this movie through. The results that we saw for Michigan, $16 billion in PPP loans issued during that time. And so a significant dollar amount it's out there. You can see as we look at the kind of distributions across the states, across the country, I think it probably was in one of those upper tiers of the amount of money that got put out into the economy in Michigan. So again, well done, and thank you for that. What it did as far as the impact, looking at the overall results, so over almost 4.9 million loans that are now still outstanding. And I think some of those actually, they just paid it back. They didn't need the money and they paid it back. But we're looking at approximately over 51 million jobs supported through this. And as we kind of go through the formula and see what is the kind of average comp that was supported by this, right around $49,000. So the individuals that should have benefited from this program on average earning about $49,000 a year. So again, great work, and I think definitely reap the benefits from this as we've kind of moved through the pandemic situation. For you and for the banks and for our clients that we've worked with, this was a huge impact as far as the number of notes. We see that huge spike in the number in the total dollars outstanding in C&I loans that happened because of this. I think phenomenal amount of production, far exceeds anything that the SBA ever did, and then compressed that into a short period of time for that. And so on the books right now, we're seeing that it's approximately 25% of the number of notes are within the PPP program today on any given balance sheet for a financial institution. As we look at the participants themselves, predominantly the banks that were participating in that. So just over 4.4 million loans produced by almost 4,300 banks across the country. And the thing I wanted to highlight here is we're kind of leading into some of the next themes that we're going to talk about, is that almost 85% of the financial institutions that did these loans, it was their first SBA loan since 2018 or earlier. So we're talking at least 18 months since the vast majority of you financial institutions that did these loans, this is your first SBA loan for a long time. So kind of kicking off the rust and getting back into the SBA program, or it may have been the first time you ever did it. And so with that kind of notion of kind of trying to get yourself refamiliarized with the SBA program and doing it underneath this specific program itself does present some challenges if this goes kind of long term beyond what we're looking at. And so that's why we're focusing on the forgiveness aspect here during this presentation. When you also look at it, the impact on the balance sheets. So we took a look at, what was the average, just, looking at the total dollars done by the asset category size here for this, and then what is the average PPP loans outstanding per lender, and then comparing that to the average asset size of the financial institutions within that range. So we could see that you now have on the books approximately 5% or more of your total assets are in this one product asset category, PPP loans. Now the 100 million or less category, 30% looks pretty daunting. We know it's at least 10%. You got average of $10 million per lender, and we can't cap it out beyond 100 million. So that means that there's at least 10% of the assets of those financial institutions of 100 million or less in total assets are sitting in these PPP loans. So we have a significant amount of assets in this particular category that are weighing on our balance sheets today. So with this, it kind of gets us into what's next. Now what do we have to do? And I keep thinking back to, if you've seen the movie The Martian with Matt Damon in there, he's just been stranded on Mars, and he's like, hey, I'm by myself and I can just kind of kick back and let things happen, or I can get to work. And you just begin. Now we're going to solve one problem, we're going to move into the next one and solve that, and continue to progress through these problems, and we'll ultimately get through all of this. And that's the kind of attitude I think we're going to have to tackle or assume as we go through the process here. And as we're talking about problems, I try to classify these particular problems within the program itself as things that have been put upon you. You really didn't have much of a choice when you did these loans. It was, we got to get this money out. It's for the good of the country, for the economy, and ultimately it should be, hopefully, for the good of your portfolios with your small business clients in particular. So first issue that we're looking at is, hey, we did do loans with two different sets of maturity dates. So we've got the bulk of them sitting with a 2-year maturity, and then the others with a 5-year maturity. It's likely that we're going to sync these up. And we're seeing clients already doing that, where they're moving all the 2-year maturities to that 5-year maturity. So it doesn't impact anything as far as the ability to get the loan forgiven, but it just kind of puts everything on even ground here. And realize that if we do have anything that's left, it hasn't gotten forgiven through the process, to get it repaid in 2 years probably is not likely. And we're going to need that full 5-year maturity under the program. So we've got clients that what they've done is working with their legal counsel. They drafted basically a disclosure that's been sent out to their clients and notifying them of a change in terms on these loans, these specific loans, and moving it out from a 2-year maturity out to the 5-year maturity. You may have already done that, and it's so great. If you haven't, it's a possibility that you may want to do this with your loans themselves. The other thing that's been put upon you, 1% interest rate. I don't think anybody really thought at the beginning of this year that we were going to be sitting with 5+% of your assets only earning the 1%. You would have chosen different vehicles, likely, particularly loan vehicles. You would have been not pricing it at 1%. And so it's better than the 10-year treasury yield. It ticked up a little bit over the last couple of days, but still not at 1%. And fortunately, they did provide for some funding vehicles that didn't force you to actually have to go out and get hot money to support this for a short period of time. So there was that type of a compensation, but it's still a significant amount of assets that really aren't generating a significant amount of return. You had to fund the entire loan up front. When you think about it, the program, and think about it from a credit perspective, anytime you're issuing a loan that has to be spent in a specific way, you're likely trying to control those disbursements. It's like, we're almost like we made a construction loan and just gave them the money up front, and then we're hoping that they built the house or the building itself. So we would have likely done some type of control over the funding and verified, how they were spending it. Obviously we didn't want to try to control that many loans. It would have been a huge operational burden, but maybe we could have done something that would have helped us to kind of control it a little bit better. But it is what it is. So the money went out the door, and you have been dealing with the constant changes. I love to just highlight, these are some of the bullet points that were on SBA's website, and looking at, interim final rule on revisions to the 3rd and 6th interim final rules. Whew, okay, now which one are we going to actually end up with? And we're still looking at, hopefully there might be some type of, revisions to the forgiveness process. But it really is, when we're looking at the forgiveness, we don't have that much of any motivation on behalf of the borrower to actually apply. When you think about it, the biggest motivational factor would be if they have to start making payments. And technically, they don't have to start making payments for 16 months after you did the disbursement. That's 24 weeks of what they've classified as the loan forgiveness period. And then another 10 months after that to actually submit the application for forgiveness. So we have the example here that if you disperse the loan on June 25th of this year, the 24 weeks ends on December 10th of this year, and then the application has to be submitted by October 10th of 2021. So if it's submitted by October 10th and approved, then the borrower has no obligation for any kind of principal or interest. So you're sitting with the asset on your balance sheet. You're not getting any payments of that during this period of time. And you're hoping that kind of your risks that I see in this case are, one, hey, the borrower really doesn't understand their responsibilities or their obligations here. There was a survey that was done back in May after we were kind of going through the bulk of the volume of these applications, that 3 out of every 4 borrowers, they're confused by what they got. They know they got the money, but as far as the next steps, not really sure about what they have to do, or what are the terms and conditions of this. They just know they got the money and they needed it. Second risk that we see for you is, are they going to have that data and be able to actually demonstrate their compliance with those loan forgiveness requirements? So first, they didn't know, or they're unclear as to what the requirements are, and do they know what kind of information that they're going to have to collect? And then the third risk that we're seeing here is, if you wait 16 months, are they going to be around? We know the business closures that are happening, on a regular basis through this pandemic, and kind of the longer this goes on and the longer it takes for us to get back to kind of a normal operating model, are they going to close? And then are we going to be able to find them and then be able to collect that information? So got a poll question here, just checking to see, have you submitted any applications for forgiveness? And if so, what's the percentage of your PPP loans that you have actually submitted an application for forgiveness? It's been open for a while as far as, the ability to request forgiveness. From some of our clients, that there is they've got a few of their borrowers that are saying, hey, I want to apply for forgiveness. I want to get this thing off my books. I don't want to have it be on my books at my fiscal year end and so forth. So got the responses. So looks like about 84% are either 10% or fewer, or with 17% being that none there. So Good job on the other 17, getting above the 10%, which is excellent. And let's go ahead and actually put up the next poll question. Might be a little tongue in cheek here, but anybody got one approved? Maybe been, I'm sure they've been accepted. Checking to see if anybody got any approved. Nope. Yeah, that's what I was thinking. So I just had to check, and news may not be caught up just yet, and we'll be looking to see if anybody did actually get something approved here. But like we're seeing, most of you are still on the hook for these loans. You've submitted the applications, no response yet. I don't know if this is a case of the SBA is waiting to kind of hear and see if there is some type of modification in the forgiveness process. The bill that the House passed apparently had a provision in there that they were trying to set a dollar cap as far as might be 150,000 or less, just forgiving all those. And if that is the case, obviously that takes a huge operational burden off from the SBA, as well as you, the lenders in this case, to just simply wipe it out. So I don't know if they're kind of holding off on their resources right now, but the current version of the bill, CBS News just put out a few days ago that it's unlikely to move through the Senate. And so we're likely to just it's not likely that we should be depending upon that particular part of the that bill to actually make it through. So, okay. So what do? Do you pursue forgiveness? Yes. We're saying immediately start to collect the information, engage with your borrowers, and start to collect that information, the payroll records. That's the biggest thing that we've got to get. That's the majority of the forgiveness qualification is on payroll. The rent payments or mortgage payments, utility, and try to calculate those eligible expenses. I love how they kind of revised the formula so that if your owner of the business, the operating entity, also owned the real estate that was being rented or leased by the operating company, that suddenly they couldn't qualify it based upon the rent payment, but it had to be qualified based upon the mortgage interest paid if there is a mortgage on that property. So nice little nuance there that, fortunately it was a lower percentage of the total amount, but we've got these little tweaks that are happening that are now even impacting the ability to get 100% forgiven. Hopefully they made up for that with the payroll expenses because of the extended period of time going from the original 8 weeks to the 24 weeks. But we have to remember that as we're going through this, 85% of these loans, we're right in the middle of the time period in which 85% of these loans will complete their loan forgiveness period, meaning complete that 24-week period for them to use the funds. And so once we're past that 24-week period, they can't do anything to alter how they spent the money. So it's best for us to go and pursue the information to see what we can do as far as verifying how much that they actually qualify for forgiveness. And if at anything, if at all you do anything, it is get that payroll provider for your borrower. Find out who that is. You may know that already. If you do, great. If you don't, at least get that part of it, because like I said, that's the biggest portion of the qualification for forgiveness. So if you have that, at least we're getting the majority of it covered of what can be forgiven. So when we look at this, we already talked about, should we wait? Well, maybe. There still may be the reason to wait for it. We've seen some articles out there that are saying, just hold off, don't submit anything, and wait for, if there's going to be any kind of changes. We're taking more of the, let's get proactive with this now. And let's determine how much that we do have at risk right now of not being forgiven. And so we'll kind of go through this decision tree here as far as the process itself. And that is meet with the borrowers, calculate those eligible expenses to determine, hey, is the balance forgivable? And if it is, yeah, apply now. Just get it in there. you've met the requirements. It's eligible based upon your best efforts here. And so let's get that application in, so that if it goes longer term as far as any kind of, Congress response to this, well, at least we've got ours in, we've got our spot in line, and we've submitted all the documentation we need. If you find that there is a gap between the eligible expenses and the actual balance of the loan, so there's not 100% forgiveness possible in this case, let's take a look. And with that borrower, are there funds that are still available? And if there are, let's talk with the borrower and see, are you willing to pay it down? Do you need those funds? Is there any reason that you would want to hold on to those funds, or can we pay this down so that we can then apply and get forgiveness for the balance that is eligible for forgiveness? And if that's the case, if they're willing to do that, let's apply. But if they're not, if they aren't willing to pay it down, okay, then we're gonna have to wait. So, and you can understand the behaviors of the small business saying, I borrowed the money, I may need it. And I don't know if it's going to be eligible for forgiveness, but I'm still trying to survive from one day to the next here. And so I'd rather hold on to it as kind of a cushion. In that case, though, we would still say, let's figure out, can we somehow control or hold those funds? So it's a way to try to see if we can't create a buffer here for us, so that in the event that there is some change, and say the 150,000 threshold, so if it's 150,000 or less, it just gets forgiven, then you can release those funds and let the borrower have those. But if it doesn't change and they still then have to justify their forgivable balance, maybe that we can use that to offset the loan amount and then delay and then apply for forgiveness here. If there aren't any funds available, if they spend it all, obviously then let's wait. You can still collect the information now, but we'll wait to apply for the forgiveness to see, is there going to be any type of a change? So obviously that's a huge effort to undergo. And we've got to figure out, how are we going to actually then prioritize? Who do we go talk to first? And it's really trying to do some type of a risk-based prioritization here for our PPP borrowers. So first of all, and this is likely to be the smallest population based upon our understanding and talking with our clients, very unlikely that you did a PPP loan for a borrower that you don't have a deposit account with, okay? That they don't have some type of deposit relationship with your financial institution. So if that's the case, tackle those first. You're like I said here, you're flying blind. You can't see the operational aspect of the business. Are they still getting some deposits in there? Are they still writing checks? Or is there still activity? You don't see that. So reach out to those first. Should be the smallest population, tackle it, and then move on to the next. The next then is, hey, they had a deposit account with you, but they've closed it, or it's in an overdrawn status. So meaning they've either lost their liquidity, they have no deposit or reserves left, or they're in an overdrawn status, and that should be a big red flag that they are definitely struggling to make ends meet, and we may be running into a situation where they're nearing closure. So let's get with them, figure out what's happening, collect the information, and maybe you can do something to kind of help bridge the gap, or do something to support them. But in any case, get the information so that you can get the loan forgiven. Then moving in, delinquencies on the non-PPP loans. You can't be delinquent on a PPP loan. You just haven't required any payments, and you can't require any payments right now. So, and then after you've gone through those four, then the remaining population, just prioritize it based upon the percentage of deposits held at your financial institution against the PPP loan balance. So the lower the percentage, meaning, the lower dollars compared to the PPP loan balance, that would go to the top of the list. If they've got more than sufficient cash on hand in a deposit account with your bank that covers the PPP loan, then it's likely they're doing just fine, and we may be able to get through the kind of offset if we need to. But with each borrower engagement, be sure to plan it. you're planning out what's the next steps after you've had that initial engagement. So you're trying to collect as much information as you can, get that reports, the payroll reports, the interest payments, the rent payments, and so forth, and hold that in it so you keep that information so that you're able to apply on behalf of your borrower. And then if you don't have it, we're going to do those regular follow-ups. And how do we get that information out there or get that from your borrowers? Now, kind of to the first question we had. So, there was a good number of, what was it, 83%, I think it was, that did manual process to submit these applications into the SBA for the initial, approval and funding of these loans. Now we're on the other side. Well, now there's these forgiveness platforms, submitting your application for forgiveness, and these providers, this is not an all-inclusive list, but it is a list of some of the primary vendors out there that are providing these types of application platforms. Our approach here is, don't just automatically go out and sign up. It's not, you may not need it. So we do recommend, hey, evaluate your borrowing base or your borrowers. Since majority of you manually submitted these applications, now let's figure out how likely are they to actually do it on their own. Remember, 3 out of 4 of these borrowers just really don't even understand the program itself. They just know they were able to get the money. So if you're still going to have to do a significant amount of manual intervention, well, the platform may not be that big of a lift overall. It'd be nice, but remember, once you've got the information, you have still 10 months to submit the application. So it's not like you've got that compressed time window like you had when you were submitting the applications to just get the loans. You now have 10 months to submit these applications for forgiveness. So you can do a little bit more load balancing over the next 10 months to submit these applications on a regular basis and not necessarily have to get these platforms. Remember, it's a single purpose type platform, and so it may not be worth it to purchase this and try to stand these up. So with that said, you've gone through, you've evaluated your borrowers, you've collected the information, you're still kind of trudging along, you're on that wait, you're going to wait to apply for that group. Now it's still, though, you should be monitoring your portfolio. So we've got to look for, remember, our biggest danger is that they close before, we're able to submit the application. And if we have any information gaps and, whatever new requirements that could pop up, there was a little provision that was in the initial guidelines for submitting for forgiveness, and that was other information that may be requested by the SBA. Well, great, that doesn't give us a whole lot for us to go on. But what we do is monitor your portfolio. Look first, deposit account closures, or significant balance drops that you're seeing with these borrowers. It's all signs of stress, signs of credit deterioration. So we've got to get in front of that as much as possible. If they've got a line of credit with you, have they got that thing maxed out? Or are they starting to see an increase in their utilization of that line? And that combined with deposit balance issues could mean that they're getting to the end of the rope. And we need to try to intervene as quickly as we can in that case. Take a look at the personal credit. For the small business portfolios, we're always recommending at least do a soft pull on at least an annual basis of all your small business borrowers, the individuals, the guarantors, and see, are we starting to see some signs of increasing leverage? Are we starting to see some changes in their personal credit bureau scores, new borrowings elsewhere, et cetera? To give us a sign that, are we starting to see some additional stress there? And then last, you may have used business credit score models in the past. Obviously, none of these models were able to predict anything related to this and the payment performance that we've experienced with our borrowers through this epidemic. But as we're starting to come out, as things have kind of leveled out again and stabilized a bit, these scores will start to actually show, give a little more validity in their application here. So it doesn't hurt to test those out and maybe do a soft pull of those scores as well. So with that, you know, as we looked at it, by Thanksgiving of 2021, I hope that we're all able to get together and face to face, and you know, enough of this isolation and you know, quarantines and so forth. Let's pray for that to happen. But what's going to happen at Thanksgiving 2021? Really, we've got kind of three things that we're going to be seeing, and let's hope that all of you are going, yep, got them all forgiven. We're all done. That program's over. And you did an awesome job with it. You already did an awesome job getting these applications submitted, getting the money in the hands of all these borrowers. So, and now we've got to kind of do that next wave of this effort. And so let's see if we can't get to that type of a repeat of the awesome job you did initially with this. Or is it, not bad. We did pretty well. We got a significant chunk of them forgiven. We're working through some of these issues, but it's tolerable, it's all right. Or are we going to be, whew, I never want to do that again. And let's get these things off the books, and we're done with these. So obviously, maximizing the forgiveness is our best path here. That's what we originally got into this program to do. Get the money in there and then get it forgiven so that neither they nor you have any kind of ongoing responsibilities from this program. So with that, kind of open it up for questions. Any kind of questions, items that you guys would like to discuss?
Joel, I don't see any questions coming in right yet.
Okay.
I do want to thank you for recognizing that, yes, our bankers did do an awesome job. They did an amazing job. We're very proud. I wondered if you could maybe mention to us a little bit about the Gonzo banker, and maybe that would be a way for them to get further information from Cornerstone Advisors.
You bet. Yeah. So it's a, I'll even kind of, do we have it on here? We don't. Yes. So there's a Gonzo Banker newsletter that we produce. And so it's kind of, as the topics arise and we're trying to tackle it, it's a, we like to call it kind of a almost an irreverent, gritty type look at the banking industry, vendors, trends that we're seeing out there. And so it's free. Just sign up, and you know, it tends to be, it is great content. So you should be able to get some good value out of it. And you know, we're not trying to spam you with a bunch of communications or anything here. So all right. So
thank you, Joe. Yeah, we did have a question come in. Do you expect PPP round 2 to occur?
If I had to guess, depending upon this, what we're seeing is kind of signs of, are we going to get this second wave kind of coming through? Yeah, I would. And let's hope that if they do a round 2, they've learned from round 1, and we can get some better, you know, criteria for this, and kind of think through some of that, you know, both the submission of the application as well as the forgiveness. You know, there's signs that you're hearing in the news that it may become more targeted. You see the restaurant and hospitality industries, you know, petitioning for their industries to get some extra help. Obviously, the airlines are clamoring for some type of help, and so that we can avoid the furloughs there. So I do see some type of response, and it's just, got to get it through this Congress, and we've got to see what's going to happen here. So that's the biggest challenge. May not be until next year. Who knows? And then hopefully it's not too late. Good question.
Thank you, Joel. There's another question that came in regarding the change in ownership rules that were released recently. Does this extend back to past changes in ownership? Example, May 2020, despite the notice being released yesterday.
That I haven't investigated that yet fully, and my hope would be that if you made it, all the indications based upon the initial guidelines were, you are going based upon the representations provided to you at the time of application. You weren't forced to validate, that information, but you were, kind of going through and kind of confirming the calculations and so forth. So I'd have to dig into that a little bit more and research that a little bit more detail. We'll take that on.
Any additional questions? Don't see any further ones coming in. I wanted to thank all of our bankers today for being with us. Appreciate your time and your questions. We will send out the recording, as I mentioned. We will send that out by tomorrow to all of you. If you have any follow-up questions, please feel free to reach out to myself or to Jennifer and Joel. They would very much look forward to speaking with you further. So, and thank you, Jen and Joel. We appreciate your time as well and the information. So take care, everyone. Please stay safe.
Thank you. Yes.
Thank you.